Coming to you live from snowy Park City, Utah. So we got the very cold open and the very cold show today. And we're going to talk about the FOMC and a kind of a neat little time spread that Mark is going to show us. Good morning, everybody. Welcome to OBTV Traders Workshop. Hi, Mark. Hi, Jason. How are you guys?
Good. How you doing, Lex? Nice, very cold opening.
It was very cold opening. Yeah, I'm doing good. It is actually cold here. Well, it's colder in my real hometown of Chicago, but we started skiing this week, so that's our deal. But we're coming to you from a nice sunny day. Really, really pretty out here in the mountains. It's not France. Don't get me wrong. You know where the king is there.
You do have me jealous of that. I love a little week in the mountains.
Pretty good. Pretty good. All right. So were you guys surprised over any of the verbiage or the stuff that went on with the FOMC info yesterday? It kind of looks like it was telegraphed a little bit market wise. Anything? Anything? Bueller?
No, I was not. I was not surprised. They did telegraph it quite a bit. I was also not surprised by the market reaction. The only thing I was a little bit surprised is how kind of weak Jerome Powell's language was. It seemed like he was trying to settle markets down, but failed miserably in his verbiage. But no, I mean, we were all February. We've been the market has the option space has looking very bullish. It's the same as it was in 2021 and late 2020, where a lot of people are buying puts and selling calls again. So those charm flows have been rallying us quite a bit, and March is looking like it might be the same in the short, at least for a little while.
Yeah, interesting. Yes, you know what else I've noticed on the retail side is over the last week and a half, let's say, option volume has been markedly lower than average for the year, just across the board. So it's, I don't know what the reason for that is. Is it a January effect, Mark? I can't remember from the old days on the floors when we hit January and everyone's trying to get back in shape and doing dry January or damp January. Are they just not paying attention, or is there something going on with the January effect in terms of volume?
I think it's interesting that you say that about the retail numbers, because just before the show, I saw the press release from the OCC about their January volumes, and they were the third highest month on record. So someone's clearly out there trading, and obviously January has that big chunk of open interest, right? That like the leaps from January 2023 have been on the books for 2.5 years now.
Yeah, that's a good point.
And so there's a lot of like uninteresting flow. There's a lot of volume out there. It's a lot of rolling, closing, that type of positioning, but definitely interesting to hear that there isn't the sort of speculative flow. I mean, it doesn't feel like there's been that fervor in the market, as much as we've been drifting.
Yeah. I guess you should clarify. Volume was good relative. January was good, but it wasn't like December and the months before, quite frankly, at least for us. And the last few days before FOMC, it was a little sluggish, I'd say. So maybe that's what I'm feeling. That those numbers prior to this announcement, what have you, which I guess is typical. People are waiting for that kind of news, right, before they start getting busy. So
Tuesday was an epically low volume day. Like one of the lowest on the year I saw.
Yep. Jason, what's going on?
Not much. You like my my conch shell light that I can't get out of the background, but Tuesday, I mean, typically days before FOMC tend to be kind of low volume. And, again, last week was Chinese New Year, or Lunar New Year, sorry. Mm-hmm. And China was closed. So I think that might have something to do with it.
Right.
Maybe a little bit of hangover after that. There's, but otherwise, though, I've been seeing a lot of bullish, dealer positioning, and it's been nice to see that for once in a year.
Good. Good. Well, the market today, I think if my stuff is right, again, I'm on warp delay out in the mountains here. Is the NASDAQ up gigantic and the Dow Jones down kind of gigantic? Or am I saying something different?
I could check. Hold on.
NASDAQ's getting Facebook, right? Facebook had Meta, I'm sorry, had earnings this morning, and they crushed it.
Oh, they did.
Yeah, Zuck stopped pouring money down the whole of the metaverse and actually boosted some advertising revenue as far as
good for
they crushed it on their report. I see NASDAQ up 2.5%.
So I was going to ask, is it something to do? Those tech heavy companies thrive on interest rate sort of activity because of all the sort of speculative things that they might do. And does that have anything to do with that? Maybe we're seeing a flattening of interest rates kind of activity.
Definitely. FOMC is definitely not having the impact that they intended. If you look at their financial conditions index, despite Jerome Powell playing it down yesterday, it has gone up considerably. The riskiness of the market is showing almost as if he declared quantitative easing. So, it's been a lot of risk taking out there. And then, when you have these tech stocks that are very interest rate sensitive, they're very high beta to that. And that, some of them like Meta, I think has doubled with this earnings announcement. It's been a lot of that. And, the other thing too is, I don't want to pat Vollin's back again, but the option positioning ahead of these earnings, most of them have been very bullish also. I mean, Meta, it was kind of showing that 175 would be a target for Meta after earnings. I don't know what it's at now, probably like 180 or something like that. So
wow,
there's a lot.
Yes, I was going to say, wasn't Meta like sub 100 recently, like very recently? I thought I saw
it late last year. It was sub 100.
Okay, so it was like in the 90s, right?
Yeah.
Wow. I wonder if I have a position in Meta. You're thinking, how would you not know? Because I'm always doing this stuff. That's how I wouldn't know. No, I think you're right. Those stocks have gotten beaten up so bad. I look at the NASDAQ a lot, and I'm not as an indicator or anything, but I'm so tech heavy in what the things that I do that it just seems like they've been punching the daylights out of the NASDAQ. But hey, here we go. Nice to see.
Yeah. Well, as much as we like to say Meta just doubled, it's probably still, I don't know. I don't pay as close attention, but it's probably still down like 60%.
Oh, I'm sure it is. Yeah.
It needs to double a few more times.
Before I go to
That's
Mark,
that kitschy thing about percentage increases and decreases.
Yeah, right. Before I go to Mark, before we go to your stuff here, I want to ask Jason one more thing. So you mentioned you're seeing a classic dealer positioning around charm, right? I think you said,
charm,
and that we could see further rally. So let's pull that apart for a second, because I think this is interesting. I like to talk about this a lot. Can you explain a little bit about what you mean and what classic dealer positioning is for the?
Sure. So institutionally, do you want me to? I could share.
Good. Just throw it up. I'll get when you throw it up there. We can share it.
Okay. Let me. So while I'm doing this, institutionally, what most participants, or at least the biggest participants, do is they go long the stock and then they hedge it. So they buy puts and they sacrifice upside. They sell calls.
Wait, is that a collar or is that the other one? You call it a risk reversal.
That's a collar.
Long risk reversal. I call it a collar. Mark, do you call it something?
I think this is where Jason tried to crown something as, what did you call it? A bullish risk reversal?
Yeah, he did. It's so typical of people who haven't been on the floor.
No, this is a collar.
Okay, good. Now we're on the same page. All right, are you doing something? I'm showing your screen.
Yeah. I was just selecting the expirations between now and the February monthly.
Okay.
And then I'll just look at Delta for now, just to get an idea of the positioning. So right now, here at 4,000, 40.50, we
Yep.
are looking at an area where customers are hedging. So that puts the dealers on positive delta because they have short puts and then they take long calls. So the delta is very, very high up until February. And what the result of that is as those puts degrade, as the implied volatility comes down, they release that hedge. Their hedges were sold underlying. In this case, it would be ES futures. And they have to release that over time as the implied volatility goes down, because then it's less likely that those strikes are going to be hit. So when I say like the classic dealer bull positioning, that means all these institutions, the insurance companies, annuities, all the pension funds, they are now re-entering the stock market, getting long the market, and then going back to the same hedging profile that they had before the Fed pivoted to a hawkish stance. So now we're in a place where they are going to stay long and they have their hedges and they're not going to move them. And the dealers are going to be, they're already hedged appropriately, and they're going to be releasing their hedges while the pension funds are not going to be selling their longs. So it's from here, you're going to be looking at a bullish advance, at least until February option expiration. And we have a very similar outlook going into March as well.
Okay. So you mentioned Charm. So Charm is essentially, delta bleed, right? It's theta for deltas. As time goes on, and let's make sure we get it clear. Your dealer, the market making community, they're long these puts. Is that what you said? I'm sorry. They're short these puts. They're long these.
They're
calls.
short the puts.
Yeah.
Right.
So you have some delta today, but as time goes on, the out of the money versions of both of these, they both tend towards zero. Okay. So if a long call is tending towards zero for them, they're getting shorter. If a short put is tending towards zero, right, they're not as long, they're getting shorter. So they have to recover that hedge, and that's their repositioning part of this, right? And when they recover that hedge, they have to buy their underlying or get long, which could cause this market to move in the northward direction.
Right. And if you want to take a look at, we have it labeled as theta, but if you want to take a look at over the past 6 months on SPX, this is the highest charm.
Hold on, I hit Mark's one. Okay, sorry, go ahead. There it is.
This is a time of the highest charm percentile over the past 6 months. You can see it's at the 99.37th percentile. And the fact that we're still 2 weeks away from option expiration when charm tends to be higher, that's a significant number. The flip side, though, I don't want to say that this is all, sunshine and rainbows, because if there is something that causes a sell-off, those short puts that dealers they have gamma associated with them, negative gamma. And so dealers would have to sell more which could exasperate downside moves. So basically the way to have it, the way to position yourself is to be long the market, but make sure you stay hedged as well.
Yeah. Interesting point. Because, that was actually going to be something that I brought up about movement. Some external cause, whatever that may be, causes them to go through their short puts, right? And as you said, accurately, they're going to get longer, negative gamma, and have to start hitting that stock. So good. All right. Awesome stuff.
I'm going to for the, spot vol correlation spike in vol, it's going to make them even shorter from those short puts.
Yeah, exactly right. I'm going to give you the brain emoji, though. You get the brain emoji.
Woo!
Did you like
Look at
that?
those gears. I am nothing but a cog in that brain.
You got the brain emoji. All right. So now here's the other thing. So holding hands here to the next topic. Mark, we're going to talk about, do you call them time spreads or calendars? What do you call them?
I would consider those synonyms, and I go back and forth.
Okay, I think I do too. I think I call them more time spreads, and that's like a sign of my age.
I would
Like,
actually
I
say
can't
I
think
could
of
call
a real life example of when you'd say something that's you could tell the guy's an old guy or something like that. I'll think
time
about it
spread.
as you're telling.
If I say time spreads 4 times in a row, though, I want to say calendar the next time. I just don't say
Right.
time spread.
All right, get it, go at it. So let's set it up a little bit. We've got higher implied volatility in front months, a little bit lower implied volatility in back months. There's a way to take advantage of that. I think I'm gonna let you do it. Is that kind of the setup a little bit, Mark?
Yeah, so like one of the things I was watching going into the Fed yesterday was sort of just the price of a calendar spread. And so like my standard benchmark here is to capture that front month, that event vol, and then 4 weeks out. So like a 1 week, 1 month kind of time spread. Another interesting one you could think about is like the 30 or 60. That's another good one to track. But this one I think captures kind of that interesting dynamic going into Fed time where we gradually see this sloping down because the 1 week time spread has a lot of Fed variance in it. It's got that event vol. It's not going to decay as much because you're pricing in that movement. Jason, what was the straddle yesterday? Like a pretty constant, like $55 in SPX or something like that,
Yeah.
$60?
Mm-hmm.
Yeah. So, you want to keep, because that's what people are pricing that move to be. And so those options in the front month aren't going to decay as much as, you might typically expect them to, which makes your short front month, long back month get increasingly cheaper. And so that's, I think, exactly what we see here going into the Fed days, the cheapening of those time spread prices.
Yep. So, and do you use a little metric of differences in prices, or do you sort of normalize it to know what's high, what's low, just, as a thumbnail?
Yeah. So this is normalized as a percentage of stock price.
Okay.
I typically do that like with every dollar spread price divided by the stock price just to normalize across issues. And I think going in, I don't have the data from last Fed announcement right in front of me, but going into that event, you're definitely going to see stuff kind of hit those lows. But you're short gamma. Like that's the curious thing about that long time spread is just how short gamma you get with that front leg that you've sold.
Right. So so you short gamma, long Vega. It's not a lot of Vega.
That was about what I was going to say is the fact that calendars, even though you're short gamma, you become long Vega, and that can greatly impact. Like when the vol crunch happens with the Fed, your calendar squeezes, and you have a very small range of profitability.
Yeah, the farther out month, I think, Mark, you said the what do we call the regular expiration? You called it something. Cereal? Not cereal. Speaking of cereal, there's Cheerios
like
over
that.
there. The cereal expiration with the weekly. It depends. I think I remember the days we use it in earnings, right? So it's the same effect happens in earnings in an individual stock. Mm-hmm. You have an event volatility, implied volatility, right? And how do you sell it? You just can't go in and sell straddles and strangles in the month and be unhedged, right? So what was typical was to do what Mark was describing here, is to try to get the best value for a time spread that you can, knowing that you do have Vega risk, and you're hoping that the cheapness of that trade will offset that Vega sort of collapse after the news comes out, right? Mark, would you say that's somewhere in the ballpark?
Exactly. And that vol crush is real. You can be long and it moves, but it just doesn't move enough. I think at the money vol came in like 5 clicks yesterday in SPY. It just got absolutely, maybe it was only 4 clicks, but it just got slaughtered. And that takes a lot of juice out of options.
Yeah. I think you're also doing a bit of a juggling act, right? Because these time spreads or calendar spreads, especially if they're similar, same strikes, you have movement risk too, right? You can be right in terms of what your spread is, and unfortunately be wrong in the size of the move, right? So that could collapse that spread too, right?
Yeah, they're a tricky position. And especially with the directionality of them, if you're talking about being delta neutral on it, that's a different story. But you do a call time spread, you've got bias with that. You do a put time spread, you've got a delta bias with that position too.
Yeah. Now, my guess is that on the retail side, again, they typically don't behave like the market maker side, right? I don't think. So they're not really putting this trade on as a directional. Well, they could put it on as a directional bias, but they're not going to be managing gamma or managing movement of the underlying. I think it is directional. They make their choice, and they do their best to either take the profit off, or if it's going against them, roll that out or close it down, right? So unlike a market maker book where they're just going to be hedging constantly against all this stuff.
Mm-hmm.
Yeah,
exactly.
So okay, very cool. Do you have a metric number that in terms of that percent number that you showed that is just the green light goes off and you're like, got to have this on? It's like 5%. Boom, do it.
Honestly, like sort of to your the points just earlier, I don't trade that many time spreads, right? Like I think that's a difficult position to have on as a as a retail trader because of all the different things you're sort of betting on, and a trade that has that many ways to go wrong is a tough trade to find the way that it'll go right. So personally, I wouldn't say I tend to track them, or I don't tend to trade them, but tracking that level and that relative pricing between them is definitely interesting to monitor where events are happening, what the vol surface looks like more broadly.
Right. Yep. That's good. Is there?
I tend to do some time spreads. One thing that I always like to do is if I do have an opinion on what the results of the FOMC will be, I will sell the option. I will sell the option the day before, like the Tuesday option, and buy the Wednesday option, because the Tuesday one will decay while the Wednesday one stays high. So
interesting.
It just sort of finances along, right? When you're not expecting there to be much, movement in that day before.
Yeah. No, that's good.
Exactly.
I like it. Okay.
Although we've seen big moves both the day before and the day after Fed Day, too, right? Like in some ways, like sure there was a great positive reaction yesterday. I'm not closing the books on Jay Powell's, success or not until the end of the trading day today or tomorrow.
Right. Yeah. So what are we at? We're Thursday, right? So we're not serial. No, we're in the February already. You see, the months all blend together when you do damp January, or the days. I mean.
Well,
you're not damp anymore, right? You're dry.
Two nights ago.
I'm the opposite of dry now. I went from damp to damper, right? I mean, geez.
Oh, that's right. It's Friday. Or it's February.
Yeah. All right. Good deal. That was interesting. Anything else before we close it down? That was good. Very interesting stuff. That we're this all of Jason's metrics now. I mean, I had to relearn the options trading practically. All those terms I got to think in my head. I got to see graphs and all this stuff, what it all means.
Yeah,
the one thing I will say about Jason's description, and if you are looking at the market and you're saying, hey, I do think, this classic dealer positioning that we're used to seeing, expecting some ball crush, that's going to provide a lot of support to any potential rally. But with that risk to the downside, my favorite setup for this type of scenario is a broken wing butterfly, a sort of bull skewed broken wing butterfly. The irony of selling ball is that you want to sell ball when the at the money ball is 15. You don't want to sell it when it's 50. That you want to benefit from that decay and just vol rotting and us slowly drifting north on a broken wing butterfly kind of setup.
Yeah, I agree. And I knew we couldn't end this without having some sort of allusion to a bird or something that flies.
Well, you never asked me what my time spread index was called.
Well, I was going to say, I was going to ask you that. I was going to say, is there a bird name for this time spread that I don't know about? And it is?
The Raven.
The Raven. I like it.
Edgar Allan Poe inspired.
Oh, my goodness. I love it.
Why is it called the Raven? It looks more like a seagull.
Oh, yeah. The way the chart does, but we already have a seagull. So
that's true.
No, it's not a reference to, it's the reference to the idea of time, not necessarily.
I was going to say Edgar Allan Poe's The Raven has to deal with time. You got it. So Mark is way out there, so smart about all this stuff. Not only is he good in the financial industry side of it, he's good in the literal English side of things. Very good. The Raven. I love it.
Do I get a big brain icon for that maybe, or is that reserved for Jason today? Did you already give that one?
We're giving you one. We're going to give you the brain icon. Here it comes. Ready? There it is.
Oh yeah.
You need a bird icon.
I'm going to get a bird icon since we talk about
that would be
stupid
great.
birds so much. All right. Good deal. You guys have a good rest of the week. It's been interesting with the market. It's, even though I've been on vacation a little bit this week, but very, very interesting movements. So glad to see we're back to normal dealer positioning too. That one I understand the best. So let's go. We'll get the little rocket ship going north. All right. Stick around. We'll talk. You guys have a great rest of the week, and we'll see you next week on Options Brew TV, Traders Workshop.